The Federal Reserve just released the minute statement, the first under the new Fed chairman, Kevin Walsh, and the Fed has told us that rate cuts are off the table. Now, I read all 15 pages of the minute statement, and there are a handful of statements in here that I'm going to react to that send a pretty clear warning to markets. So let's get into it. Now, the first thing that jumps out to me is the committee is making it very explicit that they see no rate changes through the beginning of 2027. So the idea that a lot of investors have been having and holding on to, that interest rates are going to come down this year, as of right now, that's completely off the table. Now, a lot of investors, especially real estate investors, want rates to go down. And what I found funny through this all is that the new Fed chair got placed in there by Trump, but President Trump has made it very clear that he wants rates to go lower. In the past, he even called Powell too late, saying that Powell was reactive to interest rates instead of being proactive in the situation. Now, I've been feeling for a while now that rates would stay higher for longer. When we just look at the big picture on where the market is and where the economy stands, I couldn't see a situation unless there was a lot of stress in the economy that the Fed would just rush to drop interest rates. Inflation has been elevated above the 2% target now for quite some time, and the Fed is in this like back and forth position of keeping rates higher, but also appeasing investors by dropping the rates. Now, how I react to a statement like this is just me understanding what elevated and steady rates are gonna mean. It means that mortgage rates are not gonna go down. We're already seeing a lot of pressure on home buyers that find it unaffordable to buy a home. And it also lets me know that the market, even though it's stretched and it's been going up and up and up, it may see a pullback, because when interest rates go higher or remain elevated, this is not overall good for risky assets like the stock market. Now, throughout the entire 15-page document, there are two themes that kept showing up more than anything else, and that's inflation and AI. Throughout the minutes, they kept highlighting that inflation is remaining elevated, and it's particularly in the energy sector. Now, the energy sector has been really sensitive to inflation because of this war that's going on with Iran that's pushing up fuel and energy prices. And you don't have to look far to see that. You can go to a gas pump and see that energy is very expensive. And this affects everybody from food prices to fertilizer prices to your everyday American that's just commuting and driving to work. Now, let's think about this for a second. This is putting investors in a very tricky position. Because if you're an investor right now and you're looking at the market and you're seeing it at all-time highs, you're tempted to just play it safe. I've talked to many of the investors that I help, and they're saying, oh, the market's really high right now. I think I'm just going to wait for a pullback and stay out of the market. Well, you don't know when that pullback is going to happen. And if you're sitting on the sidelines in cash, then we see that inflation is going to wreck you because it's remaining elevated. And every single day that you're sitting on the sidelines, you're losing this battle to inflation. So if you're sitting on $100,000 in cash right now, you're automatically handing over $3,800 a year from where inflation is sitting at right now. Now, if you want to keep up with all the economic indicators that I watch to go along with the Fed minutes, I built something that's just for you. On my website, I have an economic terminal where I track all these signals in one place. The inflation trends, the interest rate hike forecast, it's all laid out for you, and you can see the direction that the US economy is moving in and do this completely for free. There's a link in the description, or you can go to my website, www.financewithsantiago.com/terminal. So while we walk through the rest of what the Fed is watching, you can pull it up, look at the terminal, and follow along with the actual data. So the Fed also discussed the current state of the market, and they state that the broad equity price indexes increased notably, boosted by robust corporate earnings and the further optimism around AI. So what the Fed is basically telling you is that the entire market right now is being propped up in some way by AI. Even a big chunk of the labor market right now in the United States is being propped up by the AI build out, all these data centers that are being constructed around the country. But here's the question that I keep asking myself in this whole situation is, what happens if you build all these data centers and you have all these expectations of higher earnings from companies from AI that's currently priced into the market, and AI doesn't actually materialize the way everyone thinks? What if it doesn't hit the bottom line for the average American, and it doesn't hit the bottom line for all these companies that are investing billions of dollars into this AI build out, all the while inflation is still running high in the background? That's a bad signal for markets overall. And so right now, the market is placing a massive bet that AI is going to boost us out of this inflation hole and boost us out of this debt hole by making workers more productive and making companies more profitable. And this is a big bet. And here we see again inflation being brought up by the Fed in their statements. They say the risk to the inflation projection are skewed to the upside, not the downside. So the Fed doesn't see inflation cooling off. They see it actually heating up all the while the market's just continuing to march forward. The Fed also had several committee members comment that price pressures had become more broad-based across a large share of goods and services, including transportation, airlines, and petrochemical products. And I'll share a personal experience with this. So I bought a ticket recently to go to Colombia, and I remember not that long ago, a plane ticket to Colombia was $600. And I'm looking at the plane tickets now, and they've more than doubled. It's $1,200 just to get to Colombia, flying from where I live. And so this is showing us that at the bottom line for regular Americans who are flying, these transportation and inflation prices are real. A few participants commented that in light of these developments, there is a case for raising the target range for the federal funds rate. And so not only are cuts off the table through 2027, but there are actually members in the room making the case to raise. Now, those same people who brought the case to raise interest rates up ultimately support holding at the current rate. So we're not there yet of rate increases, but you can feel it where a lot of the Fed right now is leaning more towards a hawkish stance. Now, there are two main things that I take away after reading these minutes. And the first is that we have to be ultra vigilant about protecting ourselves and our portfolios against inflation. And the only real way to do this is to stay invested in risk assets for the long term and let the market do its thing and play out. My second takeaway is that this market, as it stands right now, the stock market, is in an AI or bust mode. AI is propping up the whole thing, and the Fed is making it clear right here in the minutes. So if you want to watch these signals move in real time, the rate forecast, the inflation trends, and where we sit today, go ahead, visit the link in the description where the economic terminal is going to be linked. This is completely for free. And if you want to go deeper on how I position my portfolio to survive an environment exactly like this one, go ahead and check out my video. I'll link right above here.